Interest in savings. For most of human history, saving meant one thing: finding a safe place to hide your valuables. Under a floorboard, buried in a field, stitched into a mattress. The goal was simply to prevent loss or theft. The amount you put away was the exact amount you'd find later. But today, putting money in a savings account does something fundamentally different. It puts your money to work. This work is powered by interest. Think of it as a rental fee. You are letting the bank borrow your money, and in exchange, they pay you a small percentage for using it. Why do they want it? Because they turn around and lend that same money to other people for mortgages or business loans, but at a higher interest rate. The difference between the rate they pay you and the rate they charge others is how the bank makes its profit. It has a simple, yet powerful, economic engine. The real magic, however, happens when your interest starts earning its own interest. This is compounding. At first, the growth is tiny, almost unnoticeable. A few cents become a few dollars. But over decades, the effect snowballs. The growth curve steepens, turning a modest, consistent contribution into a substantial sum. It is the slow, patient, and relentless force behind building wealth. But this force is neutral. It can build you up, or it can tear you down. What happens when you reach on the other side of the equation? Dividend stocks. Imagine owning a small slice of a successful local business. At the end of a profitable quarter, the owners decide to distribute some of the earnings to everyone who invested. That, in essence, is a dividend. When you buy a share of certain publicly traded companies, you become a part owner. And when that company does well, it might choose to share a portion of its profits directly with you. These payments are the company's way of rewarding its shareholders. They are a signal of financial health and stability. Typically, the companies that pay dividends are not flashy, high-growth startups. They are mature, established giants, the kind of businesses that provide essential goods and services, and generate consistent cash flow year after year. They've already built their empires, and now, instead of reinvesting every dollar into aggressive expansion, they can afford to send some of that cash back to their owners. For an investor, this creates a reliable income stream, completely separate from the daily ups and downs of the stock's price. This cash can be spent, or, more powerfully, reinvested to buy more shares, which then generate their own dividends. This is the foundation of compounding. But a dividend is never a guarantee. It's a decision made by a company's board of directors, one that can be changed or cancelled. And a dividend that looks almost too good to be true might be exactly that, a warning sign that the company's share price is falling for a reason. Rental properties. For millions of people, the idea of home begins with a key that isn't truly theirs. It's a temporary arrangement, a space paid for month by month. This relationship is one of the oldest in human history, echoing back to feudal lords and tenant farmers working land they could never own. The modern rental property, however, represents a profound shift. It is no longer just about land for survival, it's about shelter as a financial asset. An investor buys a house or an apartment not to live in, but to generate a stream of income. The strategy is straightforward. The monthly rent is meant to cover the mortgage, insurance, taxes, and maintenance, with a little left over as profit. This is the core of the passive income dream. At the same time, the property itself is expected to increase in value, a process called appreciation. Using a bank's money through a mortgage allows an investor to control a large, valuable asset with a relatively small down payment. This financial power transforms a simple building into an engine for wealth. For the tenant, the equation is different. They trade the financial burdens of ownership for flexibility. A leaky roof isn't their problem to solve, and they can move cities with far less friction. Yet, they build no equity. Their monthly payments build their landlord's wealth, not their own. This creates a fundamental tension in cities across the globe. One person's home is another person's line item on a spreadsheet. When housing becomes a primary tool for wealth generation, the rules of the game start to change for everyone. Rate the glass and steel of a skyscraper, the sprawling complex of a modern hospital, the massive warehouses that power online shopping. For most people, owning these properties is an impossible dream, a multi-billion-dollar barrier to entry. But in 1960, the US Congress created a new kind of company designed to give ordinary people a stake in these huge assets. It is called a real estate investment trust, or REIT. Think of it like a mutual fund, but instead of holding a basket of stocks, it holds a portfolio of property. A REIT buys and manages these buildings, collecting rent from its tenants, whether they're major corporations, retail stores, or even cell phone companies. And here is the critical detail. By law, a REIT must pay out at least 90% of its taxable income to its shareholders. This structure transforms rent checks from office towers and shopping malls into a potential stream of income for investors. The universe of REITs is vast, covering everything from apartment buildings to data centers and timber forests. It allows you to invest in real estate with the same ease as buying a share of stock. A simple click turns you into a property owner. But this very simplicity, this merging of tangible property and the volatile stock market, introduces a completely different set of economic forces. Peer-to-peer lending. For centuries, if you needed a loan, you went to a bank. They were the gatekeepers of capital, deciding who was worthy and at what price. This structure left many people out, or stuck with high interest rates. Then, the internet created a new possibility. What if you could bypass the bank entirely? What if you could borrow directly from other individuals? This is the essence of peer-to-peer lending. An online platform acts as a digital marketplace. As a borrower, you submit an application. The platform assesses your creditworthiness and assigns you a risk grade, much like a bank would. On the other side are investors, everyday people with money they want to put to work. They can browse through these anonymized loan requests, reviewing the risk levels and the purpose of the loan. Instead of funding the entire amount, they can contribute small sums to hundreds of different loans, effectively becoming a miniature bank themselves. For borrowers, this can mean access to capital at more competitive rates. For investors, it offers the potential for returns much higher than a standard savings account. The platform handles the transactions and takes a small fee for connecting everyone. It's a model built on disintermediation, removing the middleman. But by removing the institution, it also removes the traditional safety net. When an individual investor lends money to a stranger online, a critical question emerges. What happens when that stranger decides not to pay it back? Affiliate marketing. You've probably done it 100 times. You watch a review for a new coffee maker, click the link in the description, and buy it. What seems like a simple transaction is actually the final step in a hidden, multi-billion-dollar system. This is affiliate marketing. At its core, it's a performance-based advertising model. A company, the merchant, wants to sell more products. A creator, the affiliate, has an audience that might be interested in those products. The merchant gives the affiliate a unique tracking link. When someone from the affiliate's audience clicks that link and makes a purchase, the affiliate earns a commission. It's a simple idea, but the technology behind it is precise. The link places a small file, a cookie, on your browser, acting like a digital fingerprint. This cookie tells the merchant's website exactly where you came from, ensuring the right creator gets credit for the sale. This model wasn't born from social media. Its modern form was pioneered by Amazon in 1996 with their Associates program, allowing everyday website owners to become a virtual sales force for the e-commerce giant. Today, it powers a massive part of the creator economy. From tech reviewers and fashion influencers to travel bloggers and financial advisors, countless creators generate revenue not from ads, but from the things they recommend. It is an ecosystem that has fundamentally reshaped the internet, quietly turning authentic recommendations into a powerful engine for commerce. But it also blurs a critical line, the one between genuine advice and a paid endorsement. Digital products. Consider the last book you bought. Did you feel the weight of the paper, or did it simply appear on your screen? That difference highlights a profound economic transformation built on assets that have no physical form. A digital product is, at its core, a file. It is the software that coordinates a global shipping network, the beta producer sells online, the meticulously designed 3D model for a video game, or the stock photograph in a marketing campaign. These goods don't roll off an assembly line. They are born from pure information, shaped by skill, creativity, and time. The economics are completely inverted. A factory spends money on raw materials and labor for every single physical item. But for a digital product, the cost is almost entirely upfront. It is the filmmaker spending a year on a documentary, or a team of engineers building an application. Once that first master file is complete, creating a second copy, or a millionth copy, costs next to nothing. The cost of distribution is just bandwidth. This unique model allows a single creator in their bedroom to build a business that can scale to millions of customers overnight. It fundamentally changes who can be a producer and what it means to sell a product. It's a world where the factory is a laptop and the inventory is infinite. It begs the question, if a product can be copied endlessly without loss, what is it that we're actually buying? Creative royalties. For decades, every time the song Happy Birthday to You was performed publicly in a film or a restaurant, a payment was made. That small fee, multiplied millions of times, funneled a fortune back to the song's rights holders. This system is a creative royalty. At its core, it is a payment made to the owner of an asset for the right to use it. For authors, it is a percentage of a book's sale price. For a musician, it might be a fraction of a cent for every stream. The name itself offers a clue to its origins. Centuries ago, the crown demanded a share of the profits, a royalty, from anyone who wanted to extract minerals from the king's land. Creators and their publishers later argued that their intellectual property was a kind of territory too. They carved out a right to be paid whenever their work was mined for profit. This system promised a steady, long-term income stream. A single hit song or a best-selling novel could pay its creator for life, generating money long after the initial work was done. But this elegant concept hides a brutal complexity. The royalty from a single song isn't one payment, it is a tangled web of different rights and performance royalties, mechanical royalties, and synchronization licenses are all divvied up between songwriters, performers, publishers, and record labels. The creator's slice of the pie is often much smaller than anyone imagines. Licensing IP. If you grew up in the last 40 years, chances are you own a piece of Star Wars, an action figure, a lunchbox, a bedspread. But George Lucas and his company, Lucasfilm, didn't manufacture any of those items. Instead, they sold to other companies the right to do so. This is the core of intellectual property licensing. A licensing agreement is essentially a permission slip. The owner of an IP, called the licensor, grants a company, the licensee, the right to use their creation in a specific way, for a specific time. In return, the licensor receives payment, typically a royalty on every sale. This model extends far beyond moving merchandise. It is the reason Adobe Photoshop can use Pantone colors, or a film can feature a famous pop song. It is why you can buy a Ferrari branded watch. For the IP owner, licensing is a powerful way to expand the brand's footprint and generate revenue without the immense costs of building factories or distribution networks. For the licensee, it's a strategic shortcut. Instead of spending millions to build public awareness for a new product, they can simply attach a well-known character or trusted brand name to it. The deal seems perfect. One side gets cash, the other gets credibility. But this symbiotic relationship rests on a fragile balance. Every time a brand hands its name to someone else, it gives up a degree of power, raising a critical question of control. App and software sales. Buying software used to be an event. ED drive to store, grab a shrink-wrap box off the shelf, and pay a hefty, one-time price. For hundreds of dollars, you received a perpetual license. That version of the program was yours to keep forever. The internet began to erode this model, but it was the launch of Apple's App Store in 2008 that completely shattered it. Suddenly, software could be bought for 99 cents, or even downloaded for free. The entire economic structure shifted. The focus moved from large, upfront payments to a continuous flow of smaller transactions, like in-app purchases and monthly subscriptions. At the center of this new universe was the platform. Apple, and later Google, would act as the sole distributor, marketer, and payment processor. For this service, they took a 30% cut of nearly every dollar that passed through their store. For developers, this was a revolutionary trade-off. They gained instant access to a global audience of millions, a distribution problem that was previously insurmountable for small teams. But the price of that access was steep. They surrendered control over their pricing, their direct customer relationships, and a significant portion of their revenue. The fight over that 30% commission would come to define the next decade, but it was never just about the money. It was a fight for who gets to set the rules for the entire digital economy. Cryptocurrency staking. For many, the idea of earning interest from a savings account is a familiar concept. Your money sits there, and the bank pays you a small percentage for the privilege of holding it. Cryptocurrency staking operates on a similar principle, but with the crucial difference. You aren't just letting your assets sit, you're actively participating in securing a digital network. This process is central to blockchains that use a method called proof of stake. Instead of relying on the immense computing power of mining, these networks depend on users who lock up their coins as a form of collateral. By staking their funds, these users become what are known as validators. Their job is to verify transactions are legitimate, bundle them into new blocks, and add them to the chain. For performing this vital service, the network rewards them, usually with newly created coins. It is a system built around economic incentives. Your stake acts as a promise of good behavior. If a validator tries to cheat the system, or even just fails to do their job correctly, the network can automatically punish them by destroying a portion of their staked coins. This penalty is known as slashing. It ensures that participants have a direct financial reason to act honestly and maintain the network's integrity. This makes the security of an entire ecosystem dependent not on raw power, but on the collective, self-interested actions of its users. Silent partnerships. When we picture a successful venture, we often imagine its visible leaders. The charismatic CEO, the brilliant inventor. But behind many of these figures is a different kind of collaborator, one who operates entirely from the shadows, silent partner. In business, their role is well defined. They provide crucial capital, the fuel for an idea, but they take no part in daily management. They are the investor who trusts the operator to steer the ship. Their name isn't on the door, and they don't attend staff meetings. They offer their resources, then step back, their presence felt only on the balance sheet. This model of quiet support isn't unique to boardrooms. It is a fundamental design of the natural world. Consider an ancient forest. We see the towering trees, reaching for sunlight, standing as symbols of strength and endurance. They appear to be solitary giants. Yet, beneath the soil, a vast, hidden network is at work. Mycorrhizal fungi form a sprawling web, connecting root to root. This fungal network acts as a silent partner for the entire forest. It mines the soil for vital nutrients and water, delivering them to the trees in exchange for energy-rich sugars. The fungus doesn't grow leaves or compete for sunlight. Its work is invisible, subterranean, but without it, the forest couldn't thrive. The tree gets the glory, but the fungus makes its growth possible. It is a powerful reminder that what we see as individual achievement is often propped up by a silent, indispensable force.